Stop scrolling, because if you're holding your wealth in the wrong place right now, you could wake up one morning and realize the rules changed overnight and you didn't get a vote. I'm not saying this to scare you. I'm saying it because the signals are getting louder, the pressure is building, and the average person is still sleepwalking like nothing can happen here. Now comment what time you're watching right now for me, because I want to see where in the world this message is landing. All right, here's what we're doing today. I just came back from a major resource and investment event in Vancouver, and I sat down with a legendary financial educator, one of those guys who's been warning about currency decay for decades. And there's a rumor flying around online that he dumped his silver to chase the latest Chinese thing. That rumor is wrong. Let me make this even more direct. Most people think confiscation looks like a movie scene, a knock at the door, uniforms, and a box being carried away. In real life, confiscation usually looks like paperwork, a form, a rule change, a temporary measure that never goes away, a tax that makes it irrational to keep what you own, a banking restriction that turns your money into a permission slip. That's why the rumor about selling silver matters. It's not gossip, it's psychology. If you can make people believe the veterans are bailing out, you can stampede the crowd. And stampedes are how wealth transfers happen. So, here's my first question for you, and I want you to answer it honestly in the comments. What do you think is the biggest threat to your money? Market crashes, inflation, or government rules? Because your answer tells me how you're thinking, and it tells me what kind of mistakes you're most likely to make next. Now, when he called silver the metal of the future, I immediately thought about something most investors never bother to study, where silver actually goes. Silver isn't just a coin metal, it's a chemistry metal. It shows up in electronics as a conductor, it shows up in industrial brazing and solder, and yes, it shows up in solar panels where tiny amounts per panel become huge demand at scale. That means the demand story isn't just investors chasing a chart, it's manufacturing lines needing consistent supply, and the supply side isn't flexible. Silver is often mined as a byproduct of other metals, which means production doesn't explode just because the price goes up. It can take years for new projects to get permitted, financed, built, and operated. So if you get a surge in investment demand at the same time as industrial demand stays firm, you don't just get a nice rally, you get a shortage narrative. And shortages make politicians nervous because shortages create anger. Now, I'm not claiming I have a crystal ball, I'm saying the structure is there. And that's why he treats silver like something you graduate into owning, not something you flip like a meme stock. Also, let's kill a common misunderstanding. People love saying silver is more scarce than gold. And then they get into internet arguments. Here's the useful way to think about it. There may be more silver in the Earth's crust than gold, but a lot of silver gets used up and scattered in ways that aren't economical to recycle at today's prices. Gold, on the other hand, is hoarded. It sits in vaults, jewelry boxes, and reserves. So when you talk about investable above-ground supply, silver can feel tight in a way gold often doesn't. That's one reason silver can move violently. And that volatility is both an opportunity and a trap. Now, when he said he stores his metals outside his home country, the room had mixed reactions. Some people heard it as paranoia. I heard it as jurisdiction management, because the first rule of protecting wealth is admitting one uncomfortable truth. You don't own what you can't keep. And you can't keep what you can't control. So whether you choose domestic storage, private storage, or something international, the point is you need a plan that doesn't depend on hoping. Hope is not a strategy. Now, people asked about confiscation like it was theoretical. It isn't theoretical. History has receded. The United States restricted private gold ownership in the 1930s. Other countries have used capital controls to trap money during crisis. Banks have done bail-ins where depositors share the pain. And modern digital payment rails make it easier than ever to apply limits quickly. Limits on transfers, limits on withdrawals, limits on what you can buy. Again, not a movie scene, a drop-down menu in a system. That's what makes this era different, the speed of enforcement. So when he says he doesn't trust the government, you don't have to agree with his politics to understand the risk management logic. If the system is stressed, policymakers will do what policymakers always do: protect the system, not you. Now, about Canada specifically, one thing people whispered about in the hallways was the fact that Canada's official gold reserves are basically non-existent. Metals are less visible until rules change. So if you've been treating metals as a magic invisibility cloak, be careful. Privacy requires discipline. Discipline in storage, discipline in disclosure, discipline in documentation. Now, he referenced the idea that when gold and silver move together, It's a warning for currency. I'll add this. Watch what happens when multiple stores of value rise at the same time. Metals, energy, even certain real assets. When everything real rises and wages lag, the public gets angry, and angry publics vote for radical fixes. That's the loop. Now, he also trashed the idea of saving in cash. Look, you need cash for stability, but you don't want to die in cash because inflation doesn't have to explode to hurt you. A few years of steady erosion can quietly destroy a decade of effort. That's why I always say, keep liquidity, but don't worship it. Now, on the education argument, I'll be blunt in my own way. A degree is not a life raft. A degree is a tool, and tools can be useful or useless depending on what you build. The danger is buying a degree with debt while ignoring the skills market. In a world where AI can write, code, design, and analyze, the winners won't be the people with the fanciest certificate. The winners will be the people who can direct systems, sell outcomes, and adapt. So if you're younger, build skills that don't get outsourced easily, build a network, and build assets slowly. That's not sexy, but it's real. Now about the wealth tax idea he mentioned, taxing valuables, art, collections, and stuff. Whether specific proposals pass or not, the direction is clear. Policymakers are exploring new ways to define wealth. And once something is defined, it can be taxed. That's why you're seeing high earners migrate. Not because they hate paying anything, because they understand math. If you can move to a place with lower taxes and similar opportunity, you just raised your after-tax return without taking more market risk. That's rational. Now here's my second comment question, and I want real answers. If you had to choose one, would you rather hold more of your net worth in property or in portable assets like metals and digital value? Tell me why. Okay, back to the part where everyone asked, where do we move? He said, get out of high-pressure zones. Let me translate that too. High-pressure zones are places where the cost of living is high, taxes are high, regulation is heavy, and social tension is high. In those zones, policy experiments happen first, and when policy experiments happen first, surprises happen first. So if you can create optionality, maybe a second residency, maybe a second bank relationship, maybe a second line of income, you reduce your risk. Even small changes can matter. Now, I also want to warn you, don't romanticize offshore strategies. They have costs, they have complexity, they can create compliance responsibilities, and they can create a false sense of safety if you do them wrong. So the goal isn't run away. The goal is don't be trapped. There's a difference. And the reason it's spreading is the part nobody is talking about. And it connects to the next phase of what's coming for everyday savers. So let's walk through what was actually said, what it really means for you, and the one mistake people are about to make at the worst possible time. Because once you understand the logic, you'll see why the next move isn't about being bullish or bearish. It's about staying unconfiscable. Now, quick note, the first he addressed the silver rumor head-on. He said, basically, I didn't sell my silver. Not a chance. And then he did something that made the room go quiet. He mentioned buying another big chunk over 1,000 ounces when prices were lower, and he said it like it was normal grocery shopping. No hype, no chest thumping, just I buy it, I hold it, I don't let it go. And then he dropped a line that's going to matter later in this video. He called silver the metal of the future. Now you might hear that and roll your eyes like, okay, everyone has a favorite asset, but listen, his reasoning wasn't sentimental. It was structural. He framed silver as a weird kind of squeeze point. It's money in people's minds, but it's also a utility input in the real economy. And that double identity creates a problem when the world gets stressed. Because when people panic, they want hard. And when industries expand, they want necessary. Silver sits in the intersection, and that's why he said he'd sold some other things over time. He even admitted he's trimmed positions in certain places, but he refuses to touch the silver pile. Now, here's where it got spicy. Someone asked him, would you still buy it at these prices? And he didn't answer like a cheerleader. He warned about greed. He basically said, don't turn into the guy who keeps pressing his luck until he gets wrecked. That's a rare answer, and it's also a clue because it tells you he's not trying to pump. He's trying to survive. And survival is the theme of this entire moment in history. Then he said something that made people laugh and then stop laughing. He said he doesn't store his stack where he lives. He said he keeps it offshore because he doesn't trust government. Now, before you get emotional about that, let's make it practical. If you think confiscation is impossible, you don't know history. If you think it can't happen in modern countries with modern banking systems, you haven't been paying attention to how fast emergency rules get written when the machine needs fuel. And that's not a conspiracy. That's incentives. When debt piles up, governments look for two things: new revenue and new control. And those two things love to show up dressed as fairness. So then the topic turned to Canada because we were literally standing there in Vancouver. People were asking a very real question. If a country's central monetary authorities don't hold much or any gold, and if confidence cracks, what do they reach for? And he didn't sugarcoat it. He basically said, resource-rich place, but policy choices can still turn it into a pressure cooker. Then, because he's blunt, he used loaded political language. I'm not here to do political cheerleading. I'm here to talk incentives, power, and money. So, let me translate the core idea without the labels. When governments feel cornered, they expand what they consider taxable. First it's income, then it's capital gains, then it's property, then it's unrealized gains, then it's the art on the wall, the land you inherited, the business you spent 20 years building, and the metals you thought were private. And the scariest part is how it gets normalized. It starts with a headline, then it's a proposal, then it's a pilot program, then it's law, and by the time most people notice, it's already in the rearview mirror. Now, right when that conversation got heavy, he pivoted hard into social tension. He pointed at the widening divide, the inability for people to even talk, and the way politics has turned into identity warfare. And he said something that should stick with you. History doesn't repeat because humans are stupid. It repeats because humans are emotional. We don't learn from past cycles when we're busy defending our tribe. And when tribes form, economics becomes a weapon. He brought up unrest in American cities and said, in his view, the country is already in a kind of internal conflict, less like tanks and more like institutions turning against each other. Now, here's my skeptical counterpoint because I want to show you I'm not just nodding along. I don't think civil war is a useful phrase for most viewers because it can make you freeze instead of plan. And freezing is how you get trapped. The more useful frame is this: trust is collapsing. Trust in currency, trust in media, trust in institutions, trust between neighbors. And when trust collapses, people hoard. They hoard cash, then they hoard goods, then they hoard assets. And governments respond by trying to keep the hoarding inside the system. That's where policy gets aggressive. So whether you call it civil conflict or trust decay, the financial result is the same: volatility, controls, and surprise rules. And then he dropped a market signal that a lot of people misunderstand. He said he watches how gold and silver move together when they behave like a pair. He takes it as a warning sign about fiat currency. Now, I'll be careful here. Correlation isn't a magic alarm bell. Sometimes metals move together because the dollar moves, sometimes because inflation expectations shift, sometimes because positioning changes, but the broader point is still powerful. When multiple hard assets start rising in sync, it's not always about metals. It can be about money losing credibility. And as recently published numbers about government deficits, interest costs, and refinancing needs show, credibility is under strain. You don't need a crash for that. You just need a slow bleed. And a slow bleed is more dangerous because it feels normal until it doesn't. Then the conversation went after the education system. He said people are still saving paper and still sending kids into debt for credentials that may not protect them. And whether you agree with his tone or not, the underlying risk is real. Automation is reshaping jobs. Not all jobs, but enough jobs that the safe path is no longer safe by default. And if you're watching this, I want you to think about it in terms of household resilience. Do you have skills that pay in a downturn? Do you have assets that don't require permission? Do you have optionality? Because if you don't, then a policy shift becomes a personal disaster. That's the part people miss. It's not the headline that hurts you. It's being forced to react with no time. And the next part of the conversation is exactly about that reaction time. He talked about wealthy people leaving high tax places. He talked about policy experiments that tax more and more categories of ownership. And he argued that in the end, the goal of certain ideologies is less private property, more centralized control. Now, whether you think that's exaggerated or obvious, the practical takeaway is this: if you concentrate your life in one jurisdiction, one currency, one bank, one set of rules, you are playing a single-player game against an opponent that can rewrite the rulebook. That's not courageous, that's fragile. So then someone asked the question everyone asks when the room gets nervous: okay, where do we go? And he answered with a simple list: hard assets, decentralize tech, and get out of the highest pressure zones if you can. But here's where we need to slow down because this is where people mess up. They hear hard assets and they sprint. They overbuy at the top. They buy the wrong thing. They store it badly. They tell the wrong people. They don't plan liquidity. And then when a pullback happens, they panic and sell right before the next leg up. So let's make this smarter. Silver can be powerful, but it can also be volatile. Gold can be steadier, but it can also be regulated. Digital assets can move fast, but they come with their own risks. Custody, volatility, regulatory uncertainty. Real estate can be a wealth machine, but it can also be a tax magnet. So, what's the real play? Diversification across systems. Not just across tickers, across systems. That's why right in the middle of the interview, I stopped and gave the audience something important. Because the risk today isn't only a recession, it's the purchasing power reset. And if you don't understand how resets happen, you'll keep thinking you have savings when what you really have is exposure. You don't need a crash. You need a slow year where everything costs a little more every month. Then the next year stacks on top of that. Then your savings turns into smaller choices, then smaller life. That's confiscation with a smile. That's the theft you don't get a news alert for. Now, I'm not telling you to do anything blindly. I'm telling you to stop thinking like a consumer and start thinking like a balance sheet. If you're successful, share your success story in the comments so others can stay motivated. Then we got into real estate. Someone asked him about property markets cooling off in Vancouver and whether people should sell property to buy metals. He did what he always does. He refused to be a personal financial planner, and I respect that. Then he explained why he personally likes real estate, not because it's pretty, because it's financeable. He said when the currency became pure debt decades ago, he learned to use debt as a tool, and that's a concept that gets abused online. So let's be clear, debt can destroy you. Debt can also multiply you. The difference is the asset, the cash flow, the rate, the duration, and your discipline. He told a story about borrowing tens of millions during a crisis. Not because he was reckless, but because he had the kind of financial statement banks trust. And that's the part most people ignore. They hear borrow and think it's a hack. It's not a hack. It's a skill. And if you don't have the skill, copying the move can ruin you. So, if you're young and watching this, here's the cliffhanger question. What if the next decade belongs to people who can read a balance sheet better than they can read headlines? Because that's where we're going. Money is becoming more technical, and while everyone argues politics, the system is turning into math. Then he got asked about business school. Someone asked, "Should I go get an MBA?" He joked, but the underlying point was serious. Education that doesn't translate to real-world leverage is expensive theater. And again, not every degree is worthless. But the way people buy degrees like lottery tickets is dangerous, especially in a world where credential inflation is real and salaries aren't keeping up with living costs in many cities. So he hit the audience with his worldview. Build assets, learn cash flow, learn taxes, learn debt, learn how money actually moves. Now I want to insert something new here that wasn't in the conversation because this is where viewers get stuck. People think assets means buy something and forget it. But in real life, assets require maintenance, legal structure, insurance, liquidity planning, and most importantly, behavior management. A lot of investors don't fail because they picked the wrong asset. They fail because they couldn't handle boredom, fear, or ego. And the next 12 to 24 months are going to test behavior. Then the interview took a turn into lifestyle decisions, renting versus buying. He gave the classic line about renting certain things that depreciate or create hassle. And he said, housing decisions depend. And he's right. It depends on your stability, your location, your cash flow, your job mobility, your family situation, and the local taxes. But here's the part that matters for this script's theme. Whether you rent or buy, you need to protect the part of your wealth that is most vulnerable to rule changes. That's the trap. People pour everything into a house and assume that makes them safe. But houses are visible, they're local, they're taxable, they're registries. So yes, property can build wealth, but it can also become a target when governments look for easy revenue. That's why Alan is rarely wise. Then he told a story about two mindsets, the credential mindset versus the leverage mindset. He joked that a PhD can stand for being poor and stuck, and he contrasted that with learning to use debt as money. Now, I'm going to challenge one more thing here because this is important. Not everyone should use debt. If you're not disciplined, avoid it. If your income is unstable, avoid it. If you're already stressed, avoid it. Because debt doesn't just multiply returns, it multiplies mistakes. So when you hear wealthy people talk about debt, don't hear it as a command. Hear it as a description of their tool set. Your tool set might need to be different. That's independent thinking. Then the conversation moved into the big macro cycles, short-term debt cycles, long-term debt cycles, and the idea that this time might be different because of global power shifts. And that's where he went straight to the tension between the United States and China. He said he's worried about conflict. And to be fair, the Taiwan issue has been one of the central flashpoints in global strategy for years, with military planning, economic competition, and tech supply chains all tangled together. You don't need to be a geopolitics nerd to understand what that means financially. Conflict risk makes government spend. Spending makes deficits bigger. Deficits make currency weaker. Currency weakness makes hard assets look stronger. And that feedback loop is why so many people feel like the world is upside down. Now, here's the cliffhanger I promised earlier. What if the next wealth confiscation isn't a guy knocking on your door? What if it's slow? What if it's a tax that creeps? What if it's a rule that limits withdrawals? What if it's inflation that steals quietly? What if it's a new reporting requirement that turns privacy into a luxury product? Because those are the real mechanisms, not movie scenes. Real mechanisms. And based on the latest publicly available filings and policy proposals that have floated around in recent years, you can see a pattern. Policymakers are increasingly comfortable discussing taxes on wealth, not just income.